As he was just mentioning, L&T has been the biggest disappointment from the earnings season so far. Top line slips about 6%, came in at 8,071 crores, a good 2,000 crores below what the street was expecting. It's the bread and butter engineering and construction business that has been seen a much lower execution than was expected. Earlier today, Udayan also caught up with the CFO of L&T, Y.M. Devasthari, and began by asking him what triggered those weak numbers.
There are some genuine delays in certain areas, some projects, as a result of which in this particular quarter we have experienced degrowth. Now, let me explain this particular point. First of all, there has not been any cancellation of any orders. Secondly, it's not that the sales have been lost. It is only the execution which is getting postponed to some extent. And there are several reasons for that. The first is there are some projects for which we have had genuine difficulties in getting fronts. I'm not talking of funds, I'm talking of getting front clearances. There are some jobs which are under execution, and those jobs in between have experienced some difficulty in front, as a result of which there has been some delay. There are some jobs where there has been some fund constraints, especially in the water sector. And this has happened in the last 2-3 months in some of the states where they have had some difficulties, and because of which we purposely decided to go slow in execution of some of those projects. The third thing is, we did genuinely expect the road projects to pick up once we reach the financial closure. However, that pickup has been a little slow, and it is only now from January onwards that the things have picked up in those 3 road projects in Gujarat. The other important point is that there are some jobs where we expected sales to be there in the current year from the new orders. Those orders, the decision-making process itself has got delayed beyond our expectations. For example, there were some projects which should have been decided 9 months ago, or 6 months ago. They are getting decided now. And we expected some execution arising out of that during this particular period, during the year. So there are several reasons because of which, during the, after the second quarter also we expected that things should pick up, but there were some other difficulties which cropped up during this particular quarter.
That is the point, Mr. Devasthari, because even the first half performance of L&T was a bit lower than what the street was expected, and you've had to lower your guidance again, leading to questions on whether you're accurately able to predict the extent of deferment of these projects, because you did not see this coming in the last quarter.
No, then I think it's not a deferment of the projects. It is actually the execution of the projects. You see, let me tell you, we have an order book of 91,000 crore. And in this order book of 91,000 crore, they're all very genuine orders. It is a fact that in some cases we did not foresee or we did not expect the execution difficulties which we have experienced in this particular quarter.
Mr. Devasthari, the most important answer that your investors will want is a clarity on by when you think these execution delays will be arrested and you can get back to at least 17, 18, if not 20% kind of revenue growth or top line growth. Okay, what is your best assessment of which quarter that process can get underway?
Then I can clearly tell you that kind of a growth will definitely be there, or much bigger growth is required in fourth quarter for us to really achieve that 10% growth for the year as a whole. So you will see clearly in the last quarter there will be much higher growth than what you are expecting. You see, the point which I was trying to make is that there are two issues. One is that there are projects where there are customer-related problems, and there are projects where there are problems related to small irritants. What we are experiencing is at most of the projects there are irritants.
United Spirits came in with strong third quarter numbers. Net profits came in at 96.85 crores. That's a near over 200% jump in net profits over the same period last year. Sales also jumped to 1,347 crores. That's nearly a 300 crore addition on the top line. My colleague Rajeshwari caught up with Vijay Mallya and began by asking him about the highlights of the third quarter and the key drivers for growth.
Well, I've always said that we focus on promoting our premium brands. We've taken price increases wherever possible. intensified our marketing and sales promotion to carry through these price increases. We've obviously succeeded with good top-line growth on a huge volume base. But more significantly, we've maintained the EBITDA margin at about 17.3%, which is extraordinary good performance given the high cost of inputs. And hopefully we are going to see the back of this high cost of input, particularly the molasses price, and during the next fiscal, I think we'll look at significant reductions. But despite the adversities, Telangana agitation, and therefore disruption in sales, I think we have every reason to be proud of very good performance.
That pretty much looks like you're set to meet your guidance of about 14 to 15% or even better it. How does it look, the next fiscal when you look at it, or this year, the next 9 months? How does it look, sir?
Well, I'm not going to make any forward-looking statements, but I feel pretty good. We've handled the situation extremely well during difficult times. We've achieved a good, healthy sales volume growth, even better value growth in excess of 30%. We've achieved an extraordinary increase, about 100% in our earnings, and if we could achieve all this in a tough environment, then I guess things can only get better.
I think things will only get better when the White and Mackay contracts expire. How are you prepared for that, and how exactly will it change the kind of numbers or the kind of earnings that we are getting from United Spirits itself in the next 6 to 8 months, sir?
I don't understand, what your question really seems to imply. White and Mackay is doing very well on its own. Its brands are doing well. Its mature bulk business is doing well. The White and Mackay brands that we have launched here in India are doing extremely well, of course, supported by our huge distribution network. And my objective, obviously, is for White and Mackay to become the #1 selling Scotch whisky in India, and for the White and Mackay single malt brands, Dalmore and Jura, to be the preferred single malt brands in our country going forward.
I was asking in reference to White and Mackay's contract for bulk Scotch, which is expected to expire this year. So once the contract expires, how do you see it going forward, sir?
Oh, you're referring to the contract to supply Diageo. Well, we will fulfill our contract to supply Diageo, but then we have a lot many more customers out there who are waiting to buy our mature bulk Scotch. But more importantly, as our USL volumes grow here domestically, we require more and more of that mature bulk as well. So don't forget that I bought White and Mackay principally to support the growth of the Indian business.
Coming to our favorite question, which is asking you about how you're going to reduce your debt. The last time we had spoken to you, you did say we are looking at cutting down debt. You have about 5,400 crore consolidated debt as on December 09. In the next 12 months, do you see it getting cut down to about 4,400 crore? And what is the game plan for it?
I've always said that I'm very comfortable with the levels of debt. There's no problem at all. We have an impeccable track record of actually reducing our debt before the maturation dates. We said we'd raise money from the market. We did an extremely successful QIP. We sold treasury stock. The market has reacted very favorably to these initiatives. And don't forget, I'm still sitting on a lot of treasury stock, and I will evaluate my options going forward.
Anything in the next 3 to 4 months?
Well, you always want to put deadlines before me and ask whether I'm going to do things by a certain date. Suffice it to say that my track record speaks for itself. I do what I say. I will continue to do what I say, but I'm not going to put a timeline to it.
Okay, Mr. Mallya, we're done with United Spirits, but I'm going to catch you a little bit on Kingfisher Airlines. It came yesterday and we haven't had an opportunity to talk to you about it. You know, the domestic business seems to be doing quite well. You had a highest seat factor of 80.2%, and also the operations itself is sort of looking at EBITDA positive. You feel much more comfortable about the domestic business. Could you give us an outlook or how you see it in the next 3 to 4 months?
Well, I'm obviously very, very pleased that for the first time in the history of Kingfisher Airlines, we actually broke even on our domestic network. I think that's a huge step forward for us. We had to, undertake many initiatives in order to achieve this break-even position. We cut our capacity by almost 22%, but managed to carry more guests on board our planes with a higher seat factor. We had to cope with an extremely competitive environment with irrational pricing, yet because of our impeccable service standards and service quality, we were able to actually improve our yields and get more per seat than our low-cost competition. So obviously Kingfisher is now finally on the right track.
Well, that was Vijay Mallya talking about both Kingfisher and the good numbers that have come in from United Spirits. Coming up next.